Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to rip through Twitter, see what people are sharing on social media, like we normally do. I'm going to interject my financial opinions as we go, generally related to three different topics: wealth building, commodities, and or financial topics. So let's dive in there. Let's take a look and see what people are sharing. You can find me at finding_finance, and you can join our community at finding-value.com. I do midweek updates on Wednesdays. I do question and answer sessions on the weekends. I tape everything and upload it to the website. You can also see my portfolio. You can see when I'm buying, at what price levels, what I think is of very good value, because I am timing my purchases using technical analysis and ratios and market conditions to try to get the best purchasing prices for these assets. And that's where I think the big value is. I also think I do a lot of training, which is highly valuable on the weekends. And there's a lot of training courses, videos on the website as well. So coming down, we've got liquor store guy. He says, between insurance and property taxes, my house payment is going up $400 next month. It goes from $2,625 to $3,025. This is every month. Is this happening to everyone, or is it just a Colorado thing? So I live in Colorado, and I'm not sure where this guy actually resides, but I live in Colorado Springs, and I got interested to look at what my property taxes, what they actually went up between 2022 and 2023, and then eventually 2024. I don't know what it did for 2024. I didn't really look at it. I know there was an estimate. I don't think it really went up that much. But my property taxes that I just paid for 2023 versus 2022, they went up only 3%, not 33. So when I looked at the difference, it was less than $100 that mine went up for property taxes. My insurance, my home insurance was about to skyrocket. I did get hail damage on my house last year, and my insurance was going to go up substantially from that company. I switched insurance companies this year to a new insurance company, and it is the same price that I was paying the year before. So my insurance, I'm paying exactly the same as I did the year before for my car insurance and home insurance. And my property taxes went up 3% from 2022 to 2023. So it is not the same thing. And this is, I am in Colorado as well. You want to own things governments can't print when the only likely solution for the US is to solve its debt crisis is financial repression. That is completely true. Completely true. And that's where precious metals, hard assets, all that comes in, because they are going to solve everything through the printing of money, which is inflationary. Eric Noel, I saw him write this here. He says, we remain bullish on the second half of 2024 and 2025 as oil inventories will soon sharply draw, heading to record lows by year end, while natural gas and service stocks offer upside to a much better natural gas price in 2025. I agree with that. I think the service stocks look pretty good. Natural gas definitely looks, it's been ripping, but I've already positioned when they were really low. So I'm kind of just holding on, enjoying the ride, guys. And I'll be honest, the past couple of days, I'm not really enjoying that ride. Feel like I've been getting ridden, but it's okay. That's what the markets do. They go up, they go down, and pullbacks are as expected with any market. Coming on down, Jay Parsons. He says, where are young adults moving to and away from since 2020? Here's some data from the census of Oxford Economics estimating population change among 20 to 34-year-olds from 2020 to 2023. So here are some thoughts of his. We've got Dallas, Fort Worth, Texas. I'm not going to go through all that. Let's just look at the data. So here's the data. And this is where young adults are moving to and away from. So where are they moving away from and where are they moving to? They're moving away from New York, Los Angeles, San Francisco, Oakland, and Chicago. And I will say this, I would also move away from those cities. And let's see where they're moving to. Dallas, Fort Worth, the Villages, St. George, Lakeland, Myrtle Beach, Austin, Phoenix, Houston, Atlanta, San Antonio, Tampa, Raleigh, Greenville, Nashville, Denver, Orlando, and Riverside. And I would move to those locations too. So if I were in the same situation as these guys, I would move away from these big cities just like everyone else, and I would move to these cities. And some of these probably be a serious consideration for myself. Eric says the month's supply of U.S. single-family housing has increased to 4.31 months in April. He says this is on par with the average level of months supply from 2016 to 2019, but still below the balanced level of 6 months of supply. So looking at this, this does look like an inverted head and shoulder, shoulder, head, shoulder. And maybe we do come back up to 6 months. And the affordability would be potentially driving that, in my opinion. I still think that we are underbuilt, but affordability, I think, is really hampering a lot of home sales. So if we get a slowdown in the market, if we get a move lower in yields, I think the affordability is going to go right into a lot of home buyers. But that might not occur until we see a slowdown in the market first. We do have an inverted yield curve. We could keep yields high, or they might move them even higher. Potentially we get a slowdown, maybe we get a tech crash or something on the lines of that. And we basically replicate what we did in the year 2000, 2001. That seems like a likely scenario. And that's kind of, I don't know, where my head's at. Gold Ventures, let's see what we got here. So what we have here says, and today, another silver gold U precious metals bull capitulated from mental drain. That's what happens when you watch every single price tick while not being busy what the companies effectively achieve. There is no quick rich scheme. Investing is patience, working, and building a thesis, not watching the price ticks. I would have to tend to agree with that. What I do, you can watch the individual price ticks, but you should have a strategy that works on a longer term basis if you're adopting something like I have. I'm trying to buy when things are cheap, and then I'm trying to sell them when they're expensive. The problem that most people have is that between cheap and expensive is a whole bunch of volatility. We get these big price moves up, and then we get these sharp corrections or price moves lower. Depending on what size companies you guys are buying, those price movements in the junior companies can be very big, to say the least. It's almost like you're investing in crypto. So the price movements can mentally drain someone who isn't ready for that type of action, especially the juniors. And that's also a reason why I talk a lot about portfolio allocation size. Portfolio allocation size, you can go into the juniors, but I don't weight the juniors as much as my larger allocation bets. And one of the reasons is because of the psychological aspect of it. Some people might not be ready for that type of volatility. from a psychology standpoint. Others can handle it quite easily. So there is a personality trait that is linked to investing that you need to be aware of. You need to know that when you see large volatility that you just can't handle it. So then you got to get out of the stock market and these junior companies and go into something that might not have the same volatility. But here's the thing, guys. If you want the 20 bagger or the 30 bagger or the 40 bagger, you are going to have to live with greater volatility to get it. That's the only way that you can get it. So then you're going to have to figure out a way to stay in the trade and create a strategy where you focus on something that you watch or that you research that is on a longer time frame, where you say, if this occurs, I'm going to keep holding. Now, what I do is I do that through ratios, through technical analysis on longer time frames, and I do it through market conditions, watching where we're at in the cycle. That is how I live through this volatility, is I focus on those things. And what I tell myself is, and a lot of the times at the beginning of bull markets, you're below the cost curves too. So if you're below the cost curves, you have a cheap ratio, and the market conditions are changing in favor of those assets, which take a long time. You just have to focus on that. And that's what I do, is I focus on the long term. I focus on those things. And I can teach anyone who's able and willing to learn this. I can teach you what I do. And that will give you greater and greater confidence of the cycle and how you can monitor the cycle going through it. That's exactly what I do. And this is what a lot of people lack. They get scared out of the bull market. They don't believe in the bull market. And that's where people get tripped up. They just don't know enough. They don't have that conviction built where they believe in the bull market. And here's JC Parrots. He says, this divergence is still nasty and no one seems to care. Now, could we get a pullback or a slowdown in the market in the short term? Because we're seeing the transportation average starting to roll over a little bit, potentially. But we're seeing the Dow Jones Industrial Average kind of continue its higher move to the upside. Whenever these diverge, that's where you could get some problems. A potential pullback or slowdown could occur here. So are we going to get that coming up here? And maybe gold kind of sniffs out that a slowdown is coming, and that money printing will eventually end up doing some stimulus, lowering of rates, and some money printing could be coming if a slowdown does materialize. Maybe. This last slowdown, though, we saw rates dropping in 2018 forward. The 2-year yield was dropping the whole time here. So that was front running this potential move here, almost like insiders were positioning for the slowdown in 2020. Like they knew it was going to occur before it occurred. We don't see that yet. The 2-year yield continues to climb, which means that people are not positioning in the 2-year yield. Insiders are not buying up the 2-year yield. So there is the market conditions and leading indicators that are different in this time frame than our time frame. Eric Benjamin says, manufacturing and residential construction still drive the cycle, which I agree with. Manufacturing and associated industries like trucking have experienced a brutal decline in margins and thus have cut headcount. Residential construction continues to hold elevated margins and thus has not cut headcount. The cycle is being held up by the residential construction. Totally agree with that. Normally, these two cyclical sectors cycle together and lose jobs together, thus causing a brisk rise in the unemployment rate. So far, all job losses in manufacturing and trucking have been offset by gains in the residential construction area. Sorry, guys. Leaving the unemployment rate to inch higher by an average pace of 0.03% per month over the last 17 months. So here's the data there. Geez. We can see manufacturing, trucking average operating margin declining here. And then we can see home building and residential construction going up. And this is holding the market up. Totally agree. But we are seeing weakness in other sectors here. Just to let you guys know, we are seeing that weakness. And that's that money rotating within the markets there. So it took a while. This is gold's return in 50 years exceeds bonds now. And there it is rolling on up. Going back all the way to 1974, it looks like, normalized from 1974. This would be way higher if they took it from 1970 or 71. Gold would be a lot higher than bonds. We also went through the most favorable time frame from 1982 all the way up. It's been a declining interest rate environment this entire time. Now, if we go to an increasing interest rate environment, this is going to go way lower, and gold's going to outperform. It's going to absolutely crush bonds if rates continue higher. Now, I think that will occur on the medium time frame, like looking out in years. I don't know what's going to come down like the next 6 months. 6 months to a year, because we could get a lowering of interest rates if the market does slow down. Silver is above $30, and yet there is panic. So true, though. There is some people panicking, and silver is still above 30. It's still above the breakout level, guys. And even if we go down 29, 30, or 28, 29 bucks, it's still good. We're good, guys. Just hold on. Patience here. Should we be paying more attention to transports? And this does look pretty ugly here. Yes, we probably maybe should be. And that also coincides with this dive down here for the manufacturing and trucking average operating margin. So it looks like we're getting a pullback in transport and that operating margin. Correct. Yellow Bull says, everyone is focused on investing in the AI revolution. He is focused on investing in what will power it. Nuclear will power to be the most important power source for AI data centers. I will agree that nuclear is probably the most important out in the future. But right now, I would say that the AI revolution is going to really lean on natural gas in the short term to medium term, which means the next 1 to 10 years, natural gas is probably going to go ballistic. Nuclear could probably have solutions out about a decade, maybe even a little bit further. So I agree that nuclear is a solution. I don't think it's an immediate solution. I think natural gas will be the clear winner in the short term for power burn generation, which is electricity burning generation. We've got one of my favorite charts, start rewriting the economy textbooks. Higher debt means lower yields once you pass the point of no return. So this is level of debt versus interest rate. We've got Brazil, Mexico, Indonesia, India, Poland. They all have debt levels as percent of GDP that is on the lower end. As you start creeping up higher into the higher debt load areas, they've got lower and lower interest rates. Japan is low, Switzerland's low, and then you've got some of these guys in the middle here that are around 4% or a little bit lower. So that does look to be like a trend. As debt increases, their interest rates are lower. It's almost like they had lower interest rates to begin with and took advantage of those lower rates, and now could be screwed if rates really were to increase. So here's B of A, NVIDIA. Beat goes on smooth Blackwell transition. Raise estimates, price objective to 1320. So NVIDIA did beat their earnings per share, and now some of these guys are raising their price objectives upward to 1320, at least on this one. Jesse Felder says the CRB Industrials leads global median CPI. The median of almost 50 countries' headline CPI indices by around 6 months. The rise in commodities points to the end of the global disinflation trend. So we're seeing a move higher in the CRB raw industrials year over year. And then we're most likely going to see the global median CPI year over year go up with it. You can see the 3-hump consolidation, 1 hump, 2 hump, 3 hump. You can see the big move in 2006, 7, 8, somewhere in that, or 06, 07, 08. And then you can see that we've pulled on back here, and we're probably going to go into another surge to the upside at some point here. Here's GDXJ, the miners holding the breakout and a back test of the broadening plot within the bowl. So nothing really to be too concerned about here. Here's your consolidation. We've broken out of the consolidation, and we are still above that upper support level of that pattern. So everything is holding on just fine at this current time. Celsius Energy says, with today's solid 78 billion cubic feet of natural gas storage injection, inventories have increased a total of 452 billion cubic feet so far this injection season. 27 billion cubic feet bullish versus the 5-year average and the third smallest in the last 5 years, just 21 billion cubic feet below 2021's 5-year minimum. Last year was already at 623 billion cubic feet. There's 2023. You can see that gap that we've got between the two, and we're more towards the lower end of 2020 and 2021. Here's Calvin. He says, we've actually been above trend on oil demand growth for after COVID for 4 consecutive years. We will use approximately 1.8 billion barrels more of oil in 2024 than when we did in 2019. The average pre-COVID oil demand growth rate was 1.5%. Post-COVID, the average is 3.5%, 2.2% excluding 2021. So we are above average growth before COVID. After that. So we've got greater growth levels of oil demand after than we did before all of this. Break wave, this is the freight futures. Dry bulk, Capesize is up 2%, Panamax is flat, and tankers, VLCC is down 1%, Suezmax is flat. JC Parrots, what a week so far in Sonoma. Wow, this is fantastic. So he's got a big 40-year drawdown in yields, and you can see that we've broken that downtrend to the upside. He's got Uber doing a back test. So there's a lot of companies doing back tests here. Is this a back test where we're going to go up, or are we actually going to break back down and have this be a false breakout? Don't know yet. We'll have to wait and see. And then we've got the emerging markets versus euro currency that looks like it's trying to break out here. This has had a lot of hits of resistance. 1, 2, 3, 4, 5, 6, 7, 8, something like that. We can see a big move if this does break out for emerging markets. Very big move. Grady says, gold, this ratio chart is now trying to break out. This breakout will be yet another sign that massive moves are coming for precious metals. Stay the course as the secular bull market has resumed with gold's historical breakout 5 months ago. Everything looks fine. It is going to be the ride of our lives. Make sure you'll be able to make the most of it all in every necessary way. So gold versus the S&P 500, we're breaking out to the upside. We've got the dot-com bubble down here. And then you can see a breakout of that for gold. We also have a breakout on the S&P 500 moving on up. So gold could outperform the S&P 500 potentially. It says, when this ratio chart moves up, gold is outperforming the general stock market and drawing in global capital. Yeah, he's got this nailed down here, I think. HFI says, we just printed 9.33 million barrels per day Pre-Memorial Day gasoline demand. March monthly will be a 5-year high. Wow, that is a lot. So we've got renewable diesel growth is disguising real diesel demand in the US, and storage is drawing globally, and US refinery runs are ripping. We have a lot of demand growth. That doesn't seem like a recession to me, though. It really doesn't, at least not yet. Why is BHP so keen on a takeover of Anglo American? It's all about copper. Anglo's copper division is world class, low cost, and long lasting. These types of quality copper assets are super scarce and getting scarcer. And every major mining company knows that. And this is a proven portfolio with well defined growth potential for Anglo American. Here's Grady again. Have shown I caught the lows in 2020. Let's go back down here to the breakout. So this is GYX, US Industrial Metals Index, weekly 6-week chart. We are breaking out with the MACD continuing to work its way on up. Looking pretty good. Now, if we were in a recession here, that all the recession people are talking about, and I remain open, I remain open. It's like, okay, I'll look for evidence of that. This is not evidence for that. This is the exact opposite. This is evidence that rates could go higher and that a breakout of inflation could be coming around the corner here. So that is something that I try to evaluate the markets by looking at all these different things and tying it together. And we're getting kind of mixed signals here. For instance, one signal that all the charts are sending is that the dollar could weaken. And the dollar could weaken with an emerging market increase, gold increasing, all these kind of stocks that I'm looking at could increase with a weaker dollar, like we were just looking at here. When you tie it all together, it's telling you something. It's money in the market is positioning a certain way. And that's what we're deciphering with these charts is money flows and where it is flowing and what psychological herd, the psychology of the herd, kind of what we're breaking these psychological barriers. We're breaking everything to the upside and we've got all these falling wedges in commodities and metals too. So here's uranium. This is from Scott, Chat GPT. He says, don't know factual accuracy, but seems to generally align with my understanding. Uranium stocks, pounds in the ground, resources, reserves valued at around 5 to 30% uranium spot price in 2007. So what he asked Chat GPT is, what were these companies priced at for pounds in the ground during the last bull market? Camco was priced between 20 and 30%. Uranium Energy Corp was 5 to 15%. Denison Mines 10 to 20. Uranium One 15 to 25. We've got Uranium Participation Corp 5 to 15. Uranium Resources 5 to 10. We've got Paladin 15 to 25%, and so forth. We're not even close to that right now, guys. Not even close. I mean, that would be the pounds in the ground being evaluated. If we're at, I'm just going to make the numbers easy. If we are around $100 a pound, then we would be pricing this at $15 to $25 a pound in the ground for their reserves. We're not anywhere near that. We're at some of these levels, we're at like $1, $2, $3 a pound, depending on what you are looking at for some of these developers. So we've got a long way to go for the valuation to match what it did in 2007. Kevin Bambro says, and I agree with this, personally, I don't get excited by stocks with annualized 20 times revenue and 40 times earnings like NVIDIA. Big returns are made when you find stocks trading at a few times forward earnings and low single digit for earnings. This market is a carnival, and I know how these clown shows end, but enjoy the games while they last. I agree, Kevin. He is right. We've got, this is platinum here. Platinum versus the M2 money supply, playing with a 15-year long trendline break. Getting above the blue neckline seals the deal, in my opinion. Then platinum will be moving up against the M2 money supply, and we're right there trying to break out for platinum. And hopefully we get a breakout here because I do like and enjoy my boy Platty. And I think that's about it, guys. So that's what we've got for today. Give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you like. We do have that question and answer session coming up on Saturday at 7 a.m. Mountain Time. And that is where I'm going to go into a little bit of training and kind of how I view the markets so you guys see what I see, the strategies, and all that. All right, guys, that's all I've got for today. We'll catch you next time. This is Finding Value.